Hi, and welcome to another video. Today I'm going to talk to you about liquidity, what it is, how I use liquidity to enter into my trades, how it has made me into a profitable trader rather than a trap trader running after liquidity sweeps one after the other. So what actually is liquidity? First, let us kill the myth. Liquidity is not some big banks hunting your stop losses just to spite you. That framing makes you feel like a victim, and being a victim in trading or anything in life is just not going to get you anywhere. So get that out of your mind. Nobody's hunting your stop losses. Liquidity is simple. It is basically stop losses sitting at obvious prices. So let's mark out some liquidity zones we can find on this Bitcoin chart. So we're on the 1 hour Bitcoin chart. And if, let's say, for example, someone entered here, they're going to put their stop loss over here. I'm just going to mark out, very obvious liquidity zones that we can find. Liquidity zones and stop losses if you go long. These are obvious places. Even, I put my stop loss at these levels. Those are different liquidity levels. Of course, you can go in on the chart and mark out others and more of them. That is up to you. But for this video, I'm just doing a few. Now, the first question is, what makes these levels so obvious? Well, the answer is swing points. If you've looked at my other videos, you'll hear me often saying that my stop loss will go at the swing high or the swing low. So these liquidity points are swing points on the chart. And everyone has their stop loss right over there. So where is the obvious place that price is attracted to? It is attracted to your swing highs or swing lows where liquidity is resting. Let's look at an example of a swing low. So here you can see a clear swing low. And a swing low is basically these three candles, the middle one having the lowest wick, okay? And the right one, so the next candle, does not take out the previous candle. So that makes it a nice swing. It's a swing low. Then you have a swing high. And here you're going to say, okay, well, now it's time to go long. So a trader is going to enter there, a long position, let's say up here, and they'll put their stop loss right below the swing low. Now, what does that tell you? Let's just move this over here. So they've entered on this candle, the next candle, or even, whichever candle over here. They've entered a long position. They've put their stop loss right under that swing low. Well, guess what? For most of the people that are entering a long position here are saying, well, I'll put it right below the swing high or low. But what happens is that price moves up a little bit, comes back down here on this candle, and takes out this swing low. So you got stopped out, I got stopped out, we all got stopped out, and there is a whole bunch of liquidity right under here that the market has now in order to push upwards. So what is liquidity? Liquidity is basically a bunch of things. It can be stop losses placed at swing lows or swing highs. And another thing we have is orders or limit orders. Okay, we have limit orders waiting to get triggered in order to go long. So we have stop losses under here. We have long limit orders over, under here. And that is liquidity. That is feeding to the market. The market is getting more liquidity, more contracts in order to push price up. So what's going to happen here is that when price comes back down, it's going to grab all of this. It's going to grab the stop losses. It's going to grab the long limit orders, and then price will push up. This is called a liquidity pool. And now let's look at a swing high example here, a clear swing high. You have 1, 2, 3 candles. The middle candle closes the highest, and the liquidity on the right candle does not take out the middle candle. Now it's the same thing. I'll just copy and paste this example up here. Stop losses for shorts. And here we have short limit orders waiting to get filled. Okay, obviously you go long and short, and you have long limit orders under here. You have short limit orders waiting patiently to get filled up here. And this is what happens all the time. You can just simply go to a 1 hour chart and just try to mark out all your swing levels. As you can see, I'll try to mark out some here for you. All right, 1, 2, 3. Here, 1, 2, 3. And that is basically your swing highs and lows. Now that you understand the concept of a swing high, a swing low, liquidity that is resting there, you have stop losses, you have short limit orders, long limit orders, depending on if it's a swing high or low. And now most traders do go long or short on swing levels, and that is okay. But there has to be more context to it than just one setup. Now, the one thing that I've learned in my 2 years of intense trading is that a swing level is not necessarily a trade signal. I don't enter into a position just with a swing level. What I do is I wait for a swing failure. And that is where I changed how I enter and exit positions, giving me a higher win rate for my positions. Now, it doesn't work 100% of the times. Nothing works 100% of the times. You guys need to get that through your head. Now, let's look at the swing failure pattern. And what is it? This is a great example right here, actually. First, you have a swing low, okay? 1, 2, 3 candles here. Then you have another swing low that actually takes out the low of the first swing low. So here is where it gets interesting. Here, 1, 2, 3, another swing low. And what this swing low did is it took out the low of the previous swing low, making this swing low a failed swing low. So think about what happened here. The traders that went long just got stopped out because they had their stop loss right here. And the long limit orders got filled on the swing failure pattern. Now, this is a bullish example. Now, let's have a look at a bearish example. Now, here's a bearish example of a swing failure pattern. Here we have a swing high. And here we have another swing high. 1, 2, 3, 3 candles. All right. And now what happened was price came, took out the previous swing high, closed back within price. So price did not close above this previous swing high. And there, that was your signal to go short. All right. Now, obviously, I don't only use swing failure patterns, but it is a strong confluence. What we can look for after that is, of course, the nice market break of structure. So we have an MSB here, or change in character, and then gaps. I like to enter on gaps, which is inefficiencies in the market. And here you can see some nice gaps here. And there you go. That is my signal to go short. And if I had gone short, I did not go short on this one. That would have been a nice short. You know, with whatever trading strategy that you're using. For example, I'm not going to see a swing failure pattern and just jump in and go long or short. I'm not going to see just a market break of structure or a change in character and go long or short, or even a gap, right? I use all of these different confluences to actually enter into my orders, but this is a big one that I've started using recently. And I've noticed that it is indeed a strong confluence, okay? When it lines up with the other criterias I have for going long or short. You can even scroll across and see if it took out any other swing highs for a swing failure pattern. Now, to spot a swing failure high, it could be, you know, all the way across. It doesn't necessarily have to be right next to it. So here's another swing high, but it didn't take out that liquidity yet. So you can mark this here, for example. 1, 2, 3 candles. Okay, so we have our swing high here. And what I would wait to enter into this position currently today, February 26th, is maybe, I don't know if we're going to get it. We don't always get swing failure patterns, right? Maybe a swing failure pattern, okay, that takes out the liquidity of this swing high, because everybody have, okay, their short position, their stop loss is right above that swing high. So I won't be surprised if we get a swing failure pattern which takes out this area here, previous swing high, and then we retrace further down. And that is where I would enter into, okay, let's say my short position and put my stop loss above the swing failure. I'll go short and target the stop losses that are over here. And that is how it works. I mean, you know, the markets are quite simple. You don't need to complicate things. But what you do need to do is you do need to be very consistent with your trading. You can have the simplest system ever, okay? Market break of structure, swing failure pattern, and 2R TP, take profit. But if you're not consistent with it, then how are you going to win, right? It's like driving a car. When you first start learning how to drive, if you don't practice enough, you'll never get good. You'll always be afraid, right? I used to live in New York and I didn't have a car, and when I did get my license, right, I drove very little. And when I got into the car, each time I would just freak out, right? But with practice, driving every day, driving my kids to all of the different activities, I just got driving every day. And now I don't even think about it, right? It's the same as trading. You got to practice, and with practice, you will master this thing. And guys, don't forget, if you're looking for a platform to practice your trading, BitMEX is offering currently $50 sign-up bonus when you deposit $25. And it's a great way, to get some real skin in the game without a very big commitment. So, you can practice, you can dollar trade, you can $2 trade, you can $5 trade. Right now, I'm $10 trading. That's the maximum amount I'm willing to risk per trade, okay? And I started with dollar trading. Learn cheap, make your mistakes, get great, and then you scale up. That is how we do it in trading. It is now 5 a.m. New York time. I'm going to wait for my swing failure pattern, if I get one. Then I'm going to wait for a market structure break. We're in the 1 hour time frame. Then I'm going to wait for a bearish fair value gap or gap inefficiency. And then I'm going to enter my position. I'm going to put my stop loss maybe above the gap, because I don't expect price to come back above the swing failure pattern. That is the power of the swing failure pattern. All right. Again, it's not going to work all the time, but it's going to work the majority of the time. And that is it for today's video. See you in the next one, and subscribe if you haven't already. Bye-bye.